Hello, everybody. Welcome to the technical analysis webinar this evening. My name's Troy. I'll be presenting today for AvaTrade. Before we get going, let's do a quick systems check just to make sure everything's up and running properly. If you would, just type OK in the chat box if you're hearing me clearly and seeing my screen all right. Okay, great. I've got enough responses. Looks like we're up and running fine. If anyone has any issues as we go along, just let me know. A lot happening today with the assets, with the market. We've reached even some limits that kick in from the markets. And this is not from individual brokers. This is from the feed providers and the actual origination of the assets, where if the market's dropping too fast, there's regulatory rules that prevent trading from, even on Wall Street or any place else. If you have a 7% drop or X amount drop in a short period of time, there's a 15-minute delay, and then the S&P 500 opened back up, and if it dropped 7% more, there's another delay. There are rules that kick in ever since a large crash that happened decades back or years back. So that's what was happening on some of the assets today. If some of you noticed that like the S&P 500 and some other indices were going off from being available to trading and then back, off and then back. And currently they seem to be moving and available to trade on right now, barring any more rapid crashes in those assets. The trading should remain open for new positions. And so let's go ahead, let's move forward. We'll take a look at some of the fundamental news and then go into the technicals. As we get going, keep in mind, as always, no investments are guaranteed to profit. The same holds true with Forex trading, CFD trading, spread betting, options trading. Any one move could bring a loss, could go the wrong way. That's why you obviously want to risk manage things appropriately for your balance and your goals. You can read the full risk disclosure statement on our website. But that's why we're all here, is to go over from an educational perspective some ideas, some strategies, some concepts that may have worked well in the past that hopefully can improve upon your trading strategies or help you build a trading strategy if you're brand new to things in a way that hopefully you can pull more out of the market than you're putting in. It's obviously the idea here. And about a third of all traders, you can see the percentage on the slide there, about 30%, 29% with AvaTrade profit long term. And you might say, well, that means 71% lose in the long term. And while that can hold true, think about it this way: what percent of people come and just gamble on their trading and they really don't have a true strategy and they're just guessing and not following risk management? And it's probably about 71% of traders, right? And the third or so that follow strategies and think about things from more of a professional perspective and plot things out and trade more like a chess match rather than a gambling match, thinking one step ahead, 2 steps ahead, 3 steps ahead with different moves, managing risk and those sorts of things. Those are the percentage of people that tend to be on that profitable third or so that can profit long term. And there's no reason why with AvaTrade, with all the support we provide, that percentage can't get higher and higher. And that's what I'm here, hopefully, to help improve upon returns, obviously with no promises. Now, what we cover is not meant to be financial advisement, obviously, but as I alluded to, it comes from an educational perspective. As we talk about risk, one thing to keep in mind, and I'll show you on AvaTrade's main website real quick as we get on some of the web pages to look at the fundamental news that's coming in. We have a feature on our AvaGo app, okay, specifically the AvaGo mobile app, that will log into your MT4 accounts, MT5 accounts, and there's a feature called AvaProtect with that app that allows you to protect against all losses for defined time periods for a small premium cost. So you know the exact amount it's costing you for 1 day, 2 days, 3 days, 6 hours, whatever time period you're choosing on gold, silver, and all FX pairings pretty much. It's a nice way It's a nice tool. It's a nice way to manage risk sometimes, and especially with volatility. When there's huge potential one way or the other and you're not sure which way it might swing, you can cover yourself for a defined cost in one direction in case it goes the wrong way. If it goes the right way, the sky's the limit really on potential profit. So if you haven't checked it out, download the AvaGo mobile app onto your mobile devices. Take a look, play around with the Ava Protect feature, and I'll show you some information about it as well as we go along. So technical analysis, I don't think we need to, yeah, Kenneth, the webinar has started. If you have any questions, let me know. Let me type a quick message to. I'm just letting Ken know to check his audio. Okay, so technical analysis, we don't need to go through a big slideshow about what is technical analysis. Even if you're a beginner, you'll pick it up as we're on the live charts on my demo. Technical analysis in general, it's looking at the historical movements of the asset price and looking for patterns, maybe predictable patterns that tend to repeat themselves, price levels, things that help you maybe gain an advantage to know which way the movement might go next. And while the historical movements are no guarantee of future movements, many times they are predictive in nature and help you maybe percentage-wise to improve upon what direction you think the movement will go. And it becomes especially powerful when you combine that with fundamental news. So you have an idea of which way's the wind blowing. You know, today, if all day long as oil reached resistance levels, technical analysis might say sell from the resistance level, that would have worked a heck of a lot better than buying from the support levels, which technical analysis also tells you to buy from the support. So why would the sells be working better than the buys? Well, because we all know the fundamental news was bearish on oil yesterday and today through the weekend and into the opening of the market. So clearly, with proper technical analysis, signals in one direction might work better than signals in the other direction because of the fundamental news. So many times it helps to combine what you know about the fundamentals with your technical analysis and then move forward with finding entry points. And we'll go over that idea today. Indicators, I don't cover indicators much. I think for beginners and even advanced traders, it's better to read the charts yourselves, to learn how to find the price levels and the repetitive patterns, to understand why something might be considered overbought or oversold on your own based on the historical data on the chart, because that's what the indicators are doing. They're reading the historical data. They're telling you based on how the indicator is programmed, when it's overbought, when it's oversold. You can start to see like musical notes, repetitive patterns on the charts, and understand when that pattern might repeat itself. And you'll start to know when you see it that if you had the indicator on, that yeah, it's probably giving me a signal it's overbought right now and it's time to sell, or vice versa. And you can understand what the indicator would say before you even look at the indicator. And once you understand it from that perspective, then the indicators are good to add on as extra support to maybe reinforce the direction you already think you should trade based on both the fundamentals, which the indicator can't possibly know the fundamentals, and the technicals, which the indicator does a good job of knowing. Okay, an indicator by itself wouldn't have known sell on oil with the sell signals more than buy with the buy signals, because the indicator doesn't know the fundamental news that's happening through the weekend and today. Okay, so once you learn to read the charts and follow fundamental news with your technical analysis, then adding indicators, you know which direction to trust the indicator and which direction maybe is going to throw you false signals from the indicator. So I like to start and teach methods with manual methods of technical analysis, and then later you can add indicators as a helpful tool. Okay, keep in mind as we go, ask questions at any time. This slide presumes that you should only ask questions at the end. We don't do an official question and answer session. Please interrupt me anytime. Ask questions. If you want me to repeat something or go over something that you think I missed, please chime in. Okay, so I like to do, before I do technical analysis, just a 5-10 minute overview of what's happening in the market fundamentally. You can see in literally 5 seconds of looking at this headline which direction the momentum has been today. And if you saw this earlier today, which it was the same picture and it was the same headlines 5 hours ago, 6 hours ago, 8 hours ago, you'd have known which direction you preferred to do your technical analysis to trade. Okay, and you'll see as we look at the charts how powerful that would have been today with oil and other assets to have traded in your direction of preference based on the fundamentals and have your entry points determined by the technical analysis. So with this quick overview, everything's red, right? Except the VIX volatility index is green, which is the fear index, right? Fear is up and everything stocks, indices down, okay? Does that tell you right away you'd rather be trading down on oil or up on oil? And I pick oil because it was a major mover today. What does this first, in 5 seconds, you can look at this and understand, yeah, Ebert and everybody else, you can tell in 5 seconds of doing a quick look that I'd probably prefer to find oil hitting resistance points and trade down. I trust the resistance points more than trying to trade up from the support levels, because with this kind of news and those kind of headlines, probably oil will be breaking support levels more than breaking resistance levels. And that's what I allude to with the indicators. They don't know that. The indicator can't come here and read this headline. And no, don't trust the buy signals from the indicator, but trust the sell signals. Okay. Okay, so quick overview, easy to see. Wall Street's selling off, fear, people are stressed, and oil really dropped. Okay, and we can talk about why did oil plunge. Here's another headline. And by the way, when you're doing a quick review of the fundamentals, had you done this morning, 5 minutes, you'd have known which way you preferred to trade, and you'd be in. And as you look at this, you can start to pick out which assets do I prefer to trade on too from the headlines. Big trouble. This started Friday. If you attended Friday's webinar that we did, I was talking about how Russia was not going to agree with OPEC. It was already leaking out Friday early in the day. And we talked about the support levels on oil and said market moves. If it breaks support levels, might be good. We talked about be careful with pending orders because it could gap past your wanted entry. So when you're going through a weekend, setting up pending orders going into a weekend can be dangerous. And I'll show you exactly on the chart what I'm talking about. And a couple of my clients did that. And I got emails where they didn't understand, why am I in the negative? I was in the right direction. It's because of the gapping. Okay, I'm going to show you exactly that, how market moves might have made sense rather than pending orders heading into the weekend if you're a type of trader that likes the risk through a weekend. Remember, news can change through the weekend. When the market reopens, you can get a gap in prices one way or the other. Okay, but we talked Friday about the potential for oil to drop more. Okay, and it was because of the articles that already came out on Friday about Russia saying, no, we're not on board with production cuts on oil. Okay, and why were they talking about wanting to cut output of oil production? The OPEC nations trying to get Russia to agree to it. Also, they were trying to keep the prices up on oil. You know, if your main source of revenue is selling oil, you don't want the price to drop. You'd rather cut production and sell the barrels for more per barrel. And Russia wasn't on board with that. And so as that bickering got worse through the weekend and becomes what they're referring to as an oil price war now, the OPEC nations may be trying to drive the price down enough to really hurt Russia, thinking that they can withstand low prices longer than Russia can. Boy, oil plunged. Boy, did it plunge. Okay, this is what happened over the weekend. And then keep in mind, countries are trying to do things to counteract this. The US lowered their federal interest rate by 0.5% last week. Just like that, boom, 0.5% down, it was already low. So that affects the US dollar strength, the US dollar index, and any pairings against the US dollar. Okay, so US dollar is somewhat weak now. And then they're talking about targeting specific companies, specific industries for tax relief. You need to keep an eye on that. What if they target the airline industry to give them tax breaks? Maybe Boeing comes up temporarily anyways. And last week we talked about the ability for Boeing to drop because people aren't traveling, and this pandemic was probably going to get worse before it gets better. Anyone who attended Friday and even last Monday, we talked about it. And boy, did Boeing drop as well. Okay, and some other related assets with the energy industry and travel industry. So easy to see the headlines. Now, if you're wanting to trade and you say, listen, it's volatile and I feel nervous. So, okay, I promised I would show you AvaProtect. If you go to our trading platform offerings on our website, you've got AvaTrade Go. That's our mobile app. So come to the site with your mobile and mobile device, go to AvaTrade Go, and you can download it either from Google Play or the Apple App Store. And you can see what it looks like here, how it works. There's AvaProtect. You can pick the time period, 1 day, 2 days, 3 days, 4 hours, 6 hours, whatever's available for options, and you get a flat premium cost. And any loss during that whole time period is added back when the coverage period ends, and then the trade keeps running. Or let's say you're watching a trade on gold and you've got the protection for, I don't know, 2 days, and you were buying and it drops way down unexpectedly to a major support level, and you say, well, I'm covered for another half a day, but boy, I don't think it'll drop below this support. So you could manually close the trade, and whatever the negative is, it'll add it back as you close the trade. Then you could reopen above that support. Okay, so those are options with the AvaGo app, and you can watch a video on AvaProtect in the same area, Trading Info, AvaProtect, which is the feature I'm talking about on the mobile app. It tells you all about it here, and there's a video if you get down to the bottom. Down here, there's a video that shows you some examples of opening trades on it, explains how it works. So if you haven't checked it out, especially with what's happening now, really, it's tremendous with this whole coronavirus scare and the volatility that's being created. You know, you see a lot of gloomy faces in those pictures, like I was showing you on the websites. Those are people that are only making money when it's going up. They're unhappy. You understand on our platform, you can short anything you want that's offered on the platform and make money while it's dropping. So you don't have to be sad because the Nasdaq or oil is dropping. You can be making money just as good on a bearish market as you can on a bullish market. So keep that in mind. Before we get onto the charts, let me pause for a moment. Any questions, or just type OK if you're ready to move forward. We'll get into the technical analysis next. We've got a pretty nice size attendance this evening, so I don't mind answering questions. I know some of you probably have questions. Okay, so Ken is still having problems hearing. Just letting him know. Everyone else is hearing. He needs to check his audio. Okay. All right, good. Here we go. So you guys are going to kick yourselves when I show you how easy it would have been to make money on crude oil today. Okay. First of all, let's go back to last Friday. All right. And we were talking about the webinar that I did. Okay. The webinar occurred somewhere here, right? On Friday in the afternoon before the NFP announcement, we were watching and we said, okay, downtrend. And we were looking at Nasdaq as well, the indices, and the NFP numbers came out during the webinar and they were good. The jobs numbers were tremendous. If you don't know what I mean by NFP, let me quickly show you. If you're on like investing.com or other major investment sites, you go to the economic calendar. This one's up here, you click. And if we go to last week, let me go back by date, not yesterday. Let me find the date here. Where's the date setting? Filters. Oh, that's not what I want. Click the calendar. There we go. So now I can pick last Friday, which would have been the 6th. Okay, the 6th to the 6th, apply. Okay. Now we look at the numbers that came in out of the US. This was during the webinar. We started before it. This came out and we had non-farm payrolls. Wow, look at these numbers out of the US. Everything's green. High level announcements. Non-farm payrolls are the biggest announcement out of the US each month. It's a real measure of the US economy, the job growth, and it blew it away. 273,000 new jobs. Trump's economy, since he cut corporate taxes all the way down to like 21, 22% from the upper 30s or 40% that they were, everything took off in the US. That's why the Dow Jones was ready to break 30,000 before this coronavirus hit, and then the coronavirus that created the sell-off, the fear. But these numbers were from the prior month before the coronavirus hit, and look how good the U.S. economy was doing. Look at these numbers. Everything exceeded or met expectations. Unemployment rate, jobs numbers, average earnings, everything. Okay, so this was good for the markets, and when that happened, the Nasdaq, oil, other things pulled up, and we were watching. And I said, listen, these announcements are short-term news, and if you believe that the markets might still crash, if you believe there's still fear about a global pandemic, if you believe that places like Spain and other places are going to start doing major quarantines of their financial areas and other locations, which is what happened. If you believe there's still more fear than positive, you could take advantage of this boost that went up after these good numbers came in and go with the direction you think it'll go more long term. And we were showing the support levels that could break, and oil and Nasdaq jumped to a resistance level and maybe was ready to drop again. And I said, maybe you got a second chance here to get an entry point you wish you would have had before those announcements came in. And so I think some took advantage of that. I'm not allowed to tell you which way to trade, just showing the facts and the information. And just as we were suspecting, the bigger picture news beyond these short-term numbers took over, and everything plunged again. Okay, so this is, sometimes you take advantage of short-term fundamental news when you know the longer term news that's going on, and you can read what the markets will do as well. So this was back on oil after the announcements. Maybe there was a little pull up after the numbers came in, before the big drop down, okay, and before the close on Friday. So if someone sold before it closed on Friday, probably not a lot of risk that oil was going to fly through the roof. There was a lot of fear on the market, all kinds of problems. The articles had already come out. I showed them in the webinar that Russia wasn't going to agree with OPEC. So there was a lot of reason to think oil could drop. I don't think anyone suspected it would drop as much as it did. There's not many people. I certainly didn't expect that size of a gap over the weekend, but boy, did it drop. Okay, so hindsight's 2020. Let's say you didn't make any moves last Friday on oil or Nasdaq or other things that actually looked pretty good. Okay. Let's say today you decided you wanted to make a move. You see the gap down. Okay, here's where it opened. Okay, it opened right here, the top of this red candle, and then dropped and came up, and that was the end of that first 15-minute candle. Okay, so some might be watching the technical analysis on this and say, holy cow, that gapped huge. And by the way, if you had a market move, you're way in the money with that drop. If you had a pending order waiting down here, you got messed up, okay? Because the entry prices on limit orders, if this dropped down, and let's say you were doing a buy limit, if it came down and then you wanted to buy, your limit price where you programmed it, if you thought, the first support you want to buy, that's your price, and it came down here, you opened in the negative with that. Okay, and on a pending order that was selling, you're not going to get the price up here. You're going to get the price where it opened. So the stops are not guaranteed. The limit orders are guaranteed the price that you program. So it doesn't work for you with those pending orders with big gaps. It just doesn't. So you have to be careful with pending orders that you leave open going into a weekend when you expect there could be big volatility. It's caution with that. Okay. Now, let's say you didn't have anything open, or if you had a market move already, great, you were way in the money at the open. If the market opened and you hadn't opened a trade yet, you look and you say, wow, it dropped too far. How do I buy now? What do I do? How do I sell? What do I do? It already gapped huge, and you think that's a huge movement. What's it going to do? Let me show you a couple strategies to make it so you understand the movement doesn't have to be done, and you didn't, because it already gapped from 40 something to down to 30 or so. It doesn't mean that you missed the movement, that you can't trade. And let me show you what I mean. Let's say the market opened. You look at the headlines and you say, wow, that's really bad. That's really bad news. You saw the headlines I showed you. They were there when the market opened. okay, before the market opened. So then you say, okay, what are my opportunities? Well, here's the price it opened. The first thing you can do after a gap, there are two things that technical analysis wise that traders find success with many times. One is if it starts to refill the gap, buy, okay? Does anyone think that this started to refill the gap after it opened? Did it refill the gap or did it immediately continue a downtrend? It's obvious, right? You can see that when it opened, it did not go back up to refill the gap between Friday's close and Sunday night / Monday morning's open. It never, after the opening price, never went into a higher point. So even if you put a pending order here after the market opened, a buy stop pending order, if it broke back into the gap, a buy stop would have bought and got you in on a move that maybe it was going to refill the gap back up to the Friday's close. It happens many times. But if it doesn't start to refill the gap, then that strategy never activates. And today, it never, because of the strength of the momentum and the news, it never started to refill the gap. So even if you had your pending order here as a buy stop, if it broke into the gap, it would have bought. It never broke in. Okay, you set it up. It didn't happen. No sweat. You didn't lose anything preparing for that part of the technical analysis strategy. And I wouldn't have expected it to refill the gap right after the open with the type of news and the size of the gap. That shows huge momentum. Typically with that type of gap, that type of movement, many times you'll see the movement continue immediately. Okay. So once it went into a downtrend, let's say on the 15-minute candles or 5-minute candles, and the high points started getting lower, okay, here's the initial drop. It comes up, establishes a lower high point, comes up, and now you have a slope on the high points. So this was your entry here. With the technical analysis, you're getting in after the established downtrend, going with the direction of the fundamental news and the direction of the gap. So no uptrend started, so you don't trade to fill the gap. It starts a downtrend with lower high points, and you'd say, well, aren't I getting in late? Getting in way down here? Look what happened. Downtrend continued in the direction of the fundamental news. Gap was never even tested, and down it went. Okay, simple strategy. All right, so two things that traders do many times with gaps. Trade the refill of the gap if it starts. It never started. Trade in the direction of the gap if the downtrend or uptrend continues in the direction of the gap, going with the fundamental news that caused it. And in this case, the downtrend established itself. You could have gotten in here or here, and clearly you still could have made a huge profit. Even if you got in on this second dip, 33.10, it dropped all the way to 27 and change before it started an uptrend. You'd say, well, how do I know when to get out? Well, when the downtrend ended, you started to get higher high points, higher low points. Once you saw the uptrend establish itself, you could have gotten out if you're scalping, if you're short-term moves. You could have gotten out as soon as it started to climb again. Easily $3-4 profit in that drop per barrel. Yeah, one lot position, that's 3,000 or 4,000 profit. And that's without getting in on the big gap, without getting in the first drop, waiting for a downtrend to be established, getting your proper technical entry point at a high point in this downtrend, high point, low point, high point, sell, there it goes, profit. Okay, very simple strategy. And we see it again and again. You might say, well, that's easy because you're looking at it after it happened. We do this each week. We look at these gaps. We look at two things: fill the gap and go with the trend, depending which hand shows itself. And I'm not going to tell you it works every time, but I can't remember the last week we didn't look at these without being able to see that it actually worked. Okay. Certainly it's not guaranteed, but you should, if you follow it appropriately, be able to win more than you lose. Okay. Any questions, or type okay if you're with me so far. All right, now I don't have time to look through all the names. I hope Shamira is here. We just had a one-on-one, and let me show you what Shamira and I talked about Let me get rid of all these lines and let me show you how perfectly this worked. Okay, we talked about this resistance level, the gap price. Okay, this is where it opened, this location. We talked about the fill the gap, and that your entry point to fill the gap would be if it broke above the resistance, you know, by X amount, by an amount that you deem significant, that it's not just a quick wick and down, it's a distance that you say, okay, for sure it broke the resistance. And then when we had the call, the movement was right here. It came up to this resistance. This dip was already there, and we are having the phone call here, okay, saying you see the resistance, and what I was teaching is that where did the resistance line form? Right in the same general location as the open price. You see how textbook that worked. You got a second chance. Even if you didn't catch this movement, it worked its way all the way back up once almost and dropped. And then the second time it actually tested the resistance with the wick, broke it by a hair, and right back down, and here it went. Okay. This is where you don't want to be too perfect with your stop loss, right? If you had a sell limit at the open price here to sell, if it returned to that price, your stop loss should be some distance above that, enough to avoid false signals, which would be about where I drew my line there, maybe a little lower. Okay. And so even the slight break of that, it was temporary, a small distance, it respected that and came down. If it was going to fill the gap, you would get a breakthrough candle typically that would break through larger than the other candles. And I could show you fill the gap scenarios from the past, and we've looked at them, that when it is going to come back up and then refill the gap and return to Friday's price, you'll see a larger candle than the others. That did not happen here. Did not happen. As long as you have your stop loss far enough away that it would require a bigger candle than the prior candles, which up here would have been that, you'd have been in on this sell again. Okay, very simple strategy. Now, why would you be confident that it wasn't going to immediately fill the gap? Because we checked the headlines, right? We checked the headlines. If you were looking when I was having my call a few hours back, if you were looking, we looked at the headlines. We said, look, everything's still negative. There isn't some breaking story that Russia and OPEC came to an agreement to cut production to drive oil price back up. There's no positive stories that, you know, hey, coronavirus are bad. It's really not a pandemic. No, nothing like that happened. No good news, no unexpected good news. So why should oil refill the gap? In your mind, you're probably thinking fundamentally, I feel strong that resistance level should hold and maybe it should reverse back down again. Okay, so while we're on the phone, I said a market move here would make sense technical analysis wise to sell. Technical analysis says it comes back to the resistance level, the open price. If the fundamental news didn't change that caused the downward gap, it should likely repeat what you saw right after the gap, and there it went down again. Okay. And you might say, well, that's not a significant move. It is. From 34.5, it's now at 30.9. We're talking nearly $4 drop. Okay, nearly $4 drop in the last few hours. Again, a one lot position, that's $4,000 again. Remember, we said you could have had 4,000 here going with the downtrend after the downward gap. Fundamental news was in your favor. Easy $4 drop you could have been in on. Then it returns to the resistance level, another easy $4 drop you could have been in on. Okay. There's a word that I'm thinking of, starts with a someone saying they can't hear me. Type okay if you're hearing me okay. Okay, all right. So it's just this person. Let me let Aid know it's just him. If I can type, please check your audio. Okay, there we go. So, all right. So what we're looking at here then is, and I was starting to say, allude to a word, starts with a P, okay? That something you have to have to get these entry points that you can see are working so well. Starts with a P. What am I thinking of? Kind of a long word. We didn't get in down here. We didn't get in down here, you know, at the bottom of this dip. We were patient. Patience is the word I'm making sure that all of you will remember in your minds. Technical analysis, using it to your advantage requires patience. Okay? When this dipped down here, if you were in a rush, you'd say, oh, I'm missing the movement. Let me get in. And you get in at the bottom of this wick, and oh, then it runs back up and you lose on your sell position. You have to be patient. After the gap, wait to see what's happening. Apply your strategy. Put your buy stop into the gap if it's going to return. Wait for it to consolidate and bounce back up and go sideways. Wait on the smaller candles to see, is it downtrending now or is it refilling the gap? And then once you recognize the pattern and the direction it's going, then make your move. Don't be in a big hurry. Be patient with your entry points. Patience paid off here by not getting in right after the open and this big spike, and you think, oh, it's just going to keep dropping. Let me jump in. That's not the right entry point. The recorded versions are on our YouTube channel. Let me type it for aid. Okay, so I'm just letting them know all webinars that I do are recorded and they're found on our YouTube channel. And there's a section for English webinars specifically. You'll also see Naim. He's another analyst that does webinars as well. And there's some of his recordings also. He tends to use the Bloomberg terminal. It's a nice advanced terminal. He does some special sessions that you might be interested in as well. His webinars are typically each week on Wednesday. All right, so so we see what we're talking about here. It returned to the resistance and broke. Now let me back this up with an idea. As sure as you might be that this resistance level was going to hold, and as this was climbing back up, you put a pending sell limit. That's the type of pending order that sells from a higher point. Okay, you could have switched pending order, sell limit. Sell limit, you would program it, the at price, to sell from a higher price. That's what the sell limit does. And if the movement was down here, you would have programmed it to sell from somewhere up just before the resistance so you don't miss the movement. So you might have programmed it to get in at 34 even or 39.9. Okay, and so it tests the resistance and down it went. It activated your sell and then you're in a nice profit. Let's pretend it broke the resistance. What kind of pending order could I also have prepared at the exact same time? I prepare my sell limit in case it respects the resistance and goes down. Remember, sometimes fundamental news breaks that you just can't expect. Maybe there was going to be an article 3 hours ago that came out saying, major headline, Russia and OPEC agree on production cuts. If that happened, what do you think would have happened to this resistance level? Considering the fact that this gap down because they didn't have a deal, what do you think would have happened if unexpectedly, if right now, unexpectedly, OPEC and Russia say, we've got a deal, we're all going to cut production? What do you think would happen to the movement? And what do you think this resistance level would do? Would it hold or maybe break and refill the gap? Exactly. Unexpected news might cause it to go up and break the gap. So at the same time, no matter how sure you were with your sell limit that as it was climbing that it was going to hit the resistance and drop like it did, no matter how sure you were about the fundamental news that would cause it to drop, you never know when the news might change. And so you have to prepare for the unknown as much as you are for the known. So the known was it's probably going to drop. News is bad for oil. Okay, that was the known. So you prepare your sell limit for the known information in the proper spot with your technical analysis. Then you prepare your buy stop. Okay, that's the other type of pending order. And you're correct, Ebert, it's the buy stop. You could have, at the same time, had both of them sitting there. The buy limit would activate first. If it doesn't break the resistance, you're in the money on this move. The buy stop never opens. In case unexpected news comes, you also prepare your buy stop, which means you program to buy from a higher point. for somewhere up here above the resistance. If you get a breakthrough candle that breaks the resistance by enough, it hits your stop loss on your sell and opens your buy. And then what's probably going to happen if it broke the resistance with positive news for oil and triggers your buy stop? You probably will see a refill of the gap, because the whole reason the gap existed was the bad news between US and Russia. And if that became good news, you might see a rapid filling of the gap. It makes logical sense. At least temporarily, it could fill the gap, right? Then the bigger news comes in and you could say, wow, I would do a buy stop if it broke through. Maybe I take profit right about here. And then I have a sell limit ready up here to sell again to take advantage of that high point. Why? Because the bigger news is global pandemic, major economies being put into quarantine, etc. So there's nothing wrong with taking advantage of short-lived momentum and also then switching directions for longer term moves that you think are more fundamentally based in the bigger picture. Okay. Now, as much as this fundamental news is helping you, you can look at this chart, and I alluded to the fact that it starts to look like repetitive notes almost on a music sheet. You understand where the breaks are, where the changes in momentum will be, where the tempo changes. Even if you didn't know why this gapped down, some people are pure technical traders. They'll look at this chart and say, I don't care why oil gapped down. It did. Something happened in the market, right? And so if it comes back up to this resistance level, I will sell. And I don't even need to know why I'm selling. I just see the momentum, the tempo changed. I see the repetitive pattern come up, back down, up, back down, up. That's enough. I see the rhythm. I see the tempo and the direction of the music notes, if you want to call them that. And some traders are just purely technical because the fundamentals are in the chart themselves. Even if you don't know why it moved, you can see what it caused. And so you can prepare for tempo changes with pending orders in the opposite direction, past the resistance levels. You can go in the same direction of the tempo in case it stays the same. And if it stays the same, you're winning. And then it changes, you lose one. That's okay. You have limited risk to the other side of the resistance with these opportunistic entry points. Okay? Any questions on that? The idea here is you don't have to stick to one direction and prove yourself right. It's okay to say, that move was wrong. Now I'm in the other direction. You have to have the ability to adapt, the ability to change for these types of technical analysis strategies to work. Okay, now with that said, I always look at the fundamentals first. I'm not a purely technical trader. It can work, but I still like to try and catch what's the latest headline right before I trade. Because you don't know, something might have broke right now. That might be the reason it's breaking this support, and that might clue you in to sell right now because it just broke the support and another negative article came out for oil. A purely technical trader would just say, okay, I'll sell now because it just broke this support. So there's for a technical trader, there's your opportunity. Sell now, right? It broke this support. You can put your stop loss back above that support. And if it just goes, you make a big profit. If it goes back above the support, small risk. Okay? Either one can work. I like looking at the headlines, which we did, so we could have predicted it would break this support, right? Here we are still talking about negative news for oil. We're looking at the movement you missed, while the movement you can still catch just verified it again. It broke the support. Why? Remember, we talked about the indicators being wrong half the time and being right half the time. Wouldn't the indicator have told you to buy from this support? Because after all this dropping, your RSI, your stochastic indicator, others would have said buy off this support because after all this dropping, it's oversold. By looking at the fundamental news or looking at the technicals ourselves, we can say, no. This gap tells me bad fundamental news without even looking at the headlines or with looking at the headlines. So I'm not trading up off support levels. I'm trading down off the resistance, and I'm putting sell stops in case the support breaks, and then I'm trading with the direction of the momentum of the day, the direction of the fundamental news. So just as I alluded to as we were starting, that why you might trust one direction with the indicator and not the other, and why your fundamental news combined with technical analysis is so powerful, that's exactly why we knew not to buy up off the support, but that yes, we wanted to trade down off the resistance. That's exactly why we knew to put a sell stop below here in case it breaks the support. Look at it go. If you're a scalper, you could have already took the profit. It just dropped $1.50 in the last 10 minutes as it broke that support. Just while we were talking in the last 3 minutes, it dropped another $1. Again, a one lot position, $1,000 you just made with that breakthrough move with a simple sell stop. Some people get in and out quick. They're scalpers. It breaks the support, takes that breakthrough candle type move. Remember, I said breakthrough candles are bigger than the prior. Look at the size of this candle compared to these three. 1, 2, 3, 4, 5. Look at the average size of those candles. There's the breakthrough candle. It hits your sell stop and down it goes further. Okay, so the resistance is what you meet on the way up. The support is what you meet on the way down. So Olua, I'll shorten your name because I don't want to mess it up trying to say the whole thing. The support was broken. The resistance was not broken. The resistance will break if we get some unexpected news that's positive for oil. Yet, Aruna, does it make sense that gold would be rising now? We could be looking at a chart on gold and it's the flip opposite of this. We could be drawing lines on resistance and buying as it breaks through on the way up because gold is plunging because of bad economy, fear, and everything else. That's the same reason gold's going up. We could be doing the sell positions, so predictable, breaking our supports just as we predicted, selling on oil, or we could have spent our time buying on gold as it's climbing. You see the gap up on gold, it worked its way down, then it formed a support level, up off the support, up off the support, up off the support, up off the support, okay? Sets up very similar, but in the reverse. Nasdaq, what do we see? Gap down. And again, if you did the gapping strategy here, here's the resistance level once it gapped down at the open. It never went up and challenged the gap. It continued to a downtrend. So then you sell. Look at the profit you'd have made trading in the direction of the downtrend, the direction of the gap. Your buy stop never would have entered for a fill the gap strategy because it never tried to fill. It's just like oil. Look at all the opportunity to profit on selling. Would I have made a profit on this climb? No. Not if I'm only going in the direction of the fundamental news. This climb back up, I wouldn't have profited, but once it reached the resistance, I would have been selling again. I would have lost once, and then on the breakthrough, I'd have been profiting again. Okay, so big profit here all the way down. As it came back up, as it established an uptrend, you'd have closed your sells because the downtrend ended. Once it consolidated, you might have sold at this resistance, and that one probably loses. Okay, you try it again. That was a limited risk. It breaks the support, and there you are with more profit again. So in this screen, using support and resistance, I can see realistically, I have 2 winners and 1 loser going in the direction of the fundamental news today, getting in at the resistance points and selling down, or going in the direction of the gap with the downtrend at the beginning. Okay, Nasdaq, S&P, CAC 40, they all did the same thing. Every one of the indices all around the world, okay? Never refilled the gap, go in the direction of the downtrend, look at the profit. Very, very easy, okay? And I do understand some of the indices you couldn't trade. Once they dropped 7%, the whole world was blocked from trading on them anymore. It's a built-in fail-safe in the investment sector to try and prevent fear from completely demolishing stocks and indices all at once, to let people calm down a bit, to let the algorithms stop auto trading in that direction, and then the markets reopen after a cooling off 15-minute period. It happened twice today on some of the major indices. And that's not something, it's not your broker manipulating access or something, trying to block you from profiting. That's not how it works. Trust me, AvaTrade is a hedging broker. We're always covering ourselves with outside liquidity. We love it when our traders win. That means more trading and more spreads, which is the business model. Okay, any questions before we end things today? You can see the downtrends are starting to continue. We just watched oil break the support. That was another opportunity right there live. Any questions? I think you can sit on these charts the rest of the evening into the night and you can find your spots and keep trading. Aruna, I wish I had a crystal ball and could tell you how long do I think the crash will continue. But you know what? Based on what we're looking at here, you don't need to know how long it's going to continue. Read the charts. Read the trends. That's the whole point of technical analysis. Look at the fundamental news. Make sure there isn't something that just broke right now that's going to change things. And then go read the charts, your technical analysis, and go with your breakthroughs. Go with your reversals. Go in the direction that makes sense with the current fundamental news and back yourself up with pending orders in case the news breaks unexpectedly in the opposite direction. Your stop loss cuts you if you're using stop losses with limited risk, and you're in on the opposite direction just like that with pending orders in case the news changes, right? So you don't need to know where the bottom is. Read the charts. You start to see them, like I said, they start to look like music notes. You can see the rhythm. You can see the direction of the tempo. You can see the changes. You can see where the reversals should be based on the patterns, and the fundamental news tells you what direction you might prefer. Don't get caught up in this trying to guess the bottom thing. Nobody knows for sure. You can read the charts now and they'll tell you which way to trade. You can read them tomorrow. They might tell you the opposite, and then you go that direction. Okay. All right, everybody. Thank you for joining this evening. We've been going for about an hour. I think this is a good place to stop. I do see the CAC 40 just broke the support level here. Okay. There's the support. It broke it, and now it's resistance again. So find your spots. Find your movements. If this breaks through, maybe you wait for the next resistance level to make your move. Or do half now, and if it breaks higher, do half later. It's okay too. You don't have to go all in one. Okay, thank you for joining. I'll be going again on Friday. Okay, there'll be emails coming out with the links. It's the same registration links. You can check the fundamental analysis link. You'll see the date and time for this Friday to register for the upcoming webinar also. And if you don't have the links, ask your account managers. They have them. I use the same links over and over that are being emailed out, so you can use the same ones. Aid and everybody else who's asking, the recordings are on our YouTube channel. If you go to YouTube, just keyword search AvaTrade channel, and then click on the English webinar section. You'll find them all. Today's webinar should be posted by tomorrow morning, tomorrow afternoon. Okay. All right. Thanks, everybody. Bye for now. Good luck. There's some great moves, I think, ready to go the rest of the day. Also, take advantage of this coronavirus. I hate to say that because it's a negative thing, but take advantage of the volatility while it's here. It's really a once in a decade type thing for these types of movements with this type of news. Okay. Bye, everybody, for now.